In the first two parts of this series, we discussed two ways to earn money in real estate: operational cash flow and long-term growth. These are crucial factors, but they don't tell the whole story about whether an investment is good or not. For instance, making $200 a month sounds amazing if you invested just $10,000. But if you put in $1 million for the same return? Not so great. The same idea applies to property growth. A $500,000 property increasing in value by $100,000 within a year is fantastic. But that does not look very good if it's the appreciation for a $20 million mansion. So, let's dig deeper. Previously, we covered metrics like initial cash invested, purchase price, property value, rent, expenses, and mortgage. We also discussed long-term growth metrics like mortgage principal paydown, property appreciation, and the costs of selling. Today, we'll explore performance metrics such as gross yield, cap rate, cash on cash, internal rate of return or IRR, expense ratio, and gross rent multiplier. We'll break down what each one tells you and when to use them. First up, gross yield. This is your annual gross revenue, or rent, divided by the property's purchase price. Gross yield helps you quickly identify if the property can generate enough rental income to be worth considering. For example, a gross yield of 9.1% is an encouraging sign, but it's not the end of the story. Next, let's talk cap rate. This is your annual net operating income, which is your rent after expenses, divided by the current market value. Cap rate is useful, but it has limitations for residential real estate. Firstly, it doesn't include your mortgage. Secondly, it's based on current market value, not your purchase price. So whether you underpay or overpay for a deal, the cap rate will not change. However, you can use cap rate to see how well your rental operation is doing at any given moment, even years after you first invested, and compare it with another property you're considering. Moving on to cash on cash. This metric is the most inclusive metric on the rental side of things. It's the ratio of your cash flow, or rent after all expenses and mortgage payments, to the initial investment. A negative cash on cash means that you need to put in more money out of pocket to cover the expenses, while a positive one means you will have money left over each month after paying for everything. Now, for the most comprehensive metric of them all, the internal rate of return, or IRR. This metric is a powerhouse because it takes into account every variable we've discussed. As you can see, it accounts for every metric: your initial investment and purchase price to your property's value, rent, expenses, and mortgage payments. It even factors in long-term growth variables like property appreciation and the cost to sell. Essentially, IRR is your go-to metric for comparing this real estate investment against any other type of investment, such as stocks, bonds, or even a simple savings account. One unique aspect of IRR is that it's time sensitive. For instance, if you're considering selling your property after 5 years, you'd calculate the IRR specifically for that 5-year period. Two more metrics worth mentioning, even though we don't use them much at Yubedo, are the expense ratio and the gross rent multiplier. The expense ratio is just your expenses divided by your gross revenue, and it's used to quickly compare the expenses of one deal to another. The gross rent multiplier is the purchase price divided by your gross rent, essentially the flip side of gross yield. There's no need to use both. Investors either look at gross yield or gross rent multiplier. In summary, use gross yield to quickly rule out bad investments. Use cap rate for a snapshot of your rental operations at any point of time, and compare it to other real estate deals you have acquired in the past. Cash on cash gives you an idea if you have any leftover cash or you need to contribute cash to pay for the mortgage. And IRR is your all-inclusive go-to metric for evaluating any investment, taking into account both operational income and long-term growth. Remember, these percentages by themselves cannot tell you if a deal is good or not. they only become truly meaningful when you compare them against other investment opportunities. An IRR of 24% is outstanding, when your other option offers a 5% return, but not so much if another investment could give you a 50% return for the same level of risk. Investing is a long-term game, and the more you know, the better decisions you'll make. Thanks for watching, and happy investing.